Welcome to Founder Tactics, a podcast about entrepreneurs and the communities that have shaped their journey. I am your host, Julia Lucidi. Today's episode was recorded at the Fort Lauderdale Tech Meetup. We hosted a fireside chat on the new rules of venture capital, featuring Anuj Maheshwari from Fuel Venture Capital, Sunny Patel from YXS Capital, and Fritz Spencer from EisnerAmper. The conversation explored how AI and converging technologies are reshaping venture capital, changing where capital flows, what investors prioritize, and how founders need to evolve to build durable companies. On this episode, our guests discuss why capital efficiency and disciplined execution matter more than ever. Before we get started, don't forget to follow and subscribe to the podcast on whichever platform you're listening to us on now. Next, I'll be handing over the microphone to Fritz Spencer to lead this interview. This episode is sponsored by EisnerAmper. EisnerAmper is a premier accounting firm supporting seed stage through public companies seize their next moment by helping them develop the financial frameworks that turn ideas into commercial success. To learn more about their support in audit, advisory, fractional CFO, and other financial services, visit EisnerAmper.com. All right, let's dive in. Fritz, take the mic.
My name's Fritz Spencer. I'm with EisnerAmper, fractional CFO, serving the startup space. Been working with them for over 10 years now, so it's been an incredible journey. That's a little bit about me, but I'd love to get the introductions over to my teammates here, my co-hosts, if you will. So Anuj, would you like to go?
Sure. Thanks everyone for being here. Julia, thank you for inviting me. And Fritz, thanks for moderating this. So my name is Anuj, and I am an investment associate at Fuel Venture Capital, which is a Miami-based venture capital firm founded in 2016 by a former Wall Street executive. We are a 550 million AUM firm currently on our fifth fund. We have a couple of strategies. One is our typical venture capital fund where we invest in early stage to growth stage startups, uh, primarily technology, and currently focusing on building our AI portfolio as well. And the second strategy that we have is a more late stage, concentrating on pre-IPO companies that are close to exit and trying to get access into them. I've been with the firm for 1.5 years and work with all diligences that the fund does, all investments that the fund makes, and all investor reporting as well. So kind of like have my hands almost like all over the fund as well. So happy to be here and sharing my perspective.
Yeah, my name is Sunny Patel. I'm one of the founders of YXS Capital. My partner Yotis is here as well. I'll keep my background brief. I was an investment banker for a number of years on Wall Street. I worked on a variety of IPOs and buyouts and transactions, both debt and equity. And then I left to start a satellite intelligence space company. We found a way to utilize geospatial intelligence to predict floods, fires, and hurricanes. And so I've been an operator. I've also helped raise money for different startups, ranging from pre-seed all the way to Series C, as well as fund managers, and just serving as a strategic partner. And now we're investors, primarily Series A through D. We're investing alongside, I would say, the convergence of technology, things that people read about in the news, but may not know where the funds are actually flowing. And so, yeah, we're 80% US based investments, but we source from all around the world. And yeah, that's a little bit about the company. It's called YXS Capital.
Awesome. Thank you guys for that quick introduction. I'd love to also, if you want to share, maybe you touched a little bit on the investment geography. If you'd like to also touch on that and maybe average check size and stage of investment that you guys are in.
So geography is like primarily US, but in past we have done investments globally as well. Couple of LATAM startups, couple of European ones as well. We do have like couple of partners in the Middle East region as well. But in terms of check sizes, our check sizes vary based on the company stage as well. We invest with a strategy called phased investing, where our first check is usually smaller, but as we gain more conviction into the company, we try to up and double down into them as well. So our early stage, like very small checks sometimes range from like 100 to 500, but in the bigger one, we can range from like 2 to 5 million as well.
Yeah, our portfolio positioning is a bit more concentrated. We are looking at about 20 to 50 investments, and check size is ranging from 10 million to $50 million.
Awesome. Thanks for that. So there's three main topics that I wanted to go over today. And so just while you're thinking about them and maybe some questions that you might want to have at the Q&A portion. So we're going to talk a bit about capital efficiency in deep tech, where investor discipline meets operator reality, tech convergence, which Sunny touched on, and then also the evolving art of the exit, which is ever changing. And so those are the three main topics. So to get us started in kind of the capital efficiency spot, Anuj, I'd love if you would maybe talk about what it looks like in an operating company for operating efficiency.
So I think in current environment, operating when people hear operating efficiency, they start thinking about cost cutting. I think that's the first thing that people think about. But right now, especially with AI, the most important thing is actually when you talk about efficiency, it's about how you're applying every dollar that you have towards getting outcomes which are going to actually generate you either traction or more validation or maybe more conviction from investors as well. So it's all about being more disciplined with the money that you have, being more thoughtful of where you want to put your money and your time into it, and then also making sure with the end goal in mind where you want to be. It's also about prioritizing as well. When you get capital to invest, when you get capital to actually operate a business, it's about what you're prioritizing at that moment. Are you going to just go take your capital and apply it into multiple facets of your business? Or are you going to actually take that capital, think through what is actually the main conviction points of your business and go apply it over there? Couple of things that I have noticed is that when people raise capital, they suddenly think that they want to spend all majority of it on their infrastructure, even though they haven't like proved their technological feasibility yet. A lot of times they want to invest into hiring more people without even thinking like if they add new people to the team, is that actually gonna add more accounts for them or more traction for them? So it's all those things that people have to think before they actually like spend money, rather than actually first go and spend money and then thinking about, okay, now how do we cut the cost? So that's what cost efficiency is for me.
Yeah, don't build the best road ever in the wrong direction. Um, Sonny, I'd like to talk more about how you guys are deploying capital and where you're thinking about where you strategically, place this into certain technologies. Can you talk a little bit about your investment thesis around that?
Yeah, for sure. A lot of the industry has changed. So venture capital started as more of a B2C consumer based investment thesis. Let's throw money into a bunch of different companies, see which one can become Facebook as quickly as possible. Now, with the commercialization of advanced emerging technologies, whether it's AI, robotics, defense, dual use, energy, the stuff we're investing in, we're seeing a different buyer profile, both from an investor standpoint as well as from an exit standpoint. So, what we're looking at is really what are the infrastructure level technologies that have at least 2 million in ARR, that have a commercially viable pathway to a sale, and whether that's a strategic buyer, which has broadened up. It's not just specific private equity or pension funds, it's Google's, it's Boeing's, it's Raytheon's, and there's a big mix of what these sectors look like. So we're really focused on the B2G and B2B enterprise applications of emerging tech, and we're seeing, at least I'm seeing on the M&A side, the acquisitions are happening really fast. For the specific top 0.1% deal flow, we're seeing them get all the money. There's a capitulation of venture capital in general into later stages. And so that creates opportunity for us. And so we're really looking at Series A and B, where we have enough product market fit, where we can de-risk the kind of technology stack, but we also have enough upside into the revenue growth of that business. Whereas other venture funds may be focused more on later stage. but you already lose like 3 to 5x premium if you're focused on that stage. So we're kind of looking at where's the world going, where is technology developed rapidly, where is there an application of commercial revenue, where is there a lack of capital, and how can we see a liquidity event sooner than 10 years? And that's how we formed our investment thesis.
So definitely not like a scale at all costs, it's scale with the cost.
Got to be capital efficient.
Exactly. This question is kind of for both of you guys, but these technology companies that are coming out these days are becoming more and more advanced. There's a lot of more that you need to understand, and if you're not an expert in those areas, it can be very risky. So how are you guys mitigating the technology risk with the market risk and factoring that into your portfolio theses?
Yeah, I often find funds are either one or the other. So if you're looking at market risk, so the early stage funds will underwrite the tech risk, and they're just hoping that the market risk works out. Later stage funds assume the technology actually works, and it's more of is this scalable for us at this stage? So for us, again, we're looking at, I think, the intersections and where we can be most strategic. And with risk, it's all about asymmetry and upside. So, like what we've done with our portfolio, for example, is we have a pipeline of about 300 companies so far. We look at what are specific buckets that they can fall under, whether that's, let's say, a moonshot opportunity, an anchor opportunity, which is, let's say, Series D and up, or a core position of Series A and B. And so, I think when you bring in a little bit more sophistication into portfolio construction, it changes how we look at risk and then returns ultimately.
For us, we what we have actually done is we have changed our underwriting criteria in past 1 year as the technology has evolved, and we now demand more conviction from any company that we are underwriting at a time. And when I say conviction, we earlier we were looking at more like on the technology side. Today, is their technology defensible? But as we move ahead, we realize that in future or maybe near term as well, more than technology, how their distribution is, that's gonna be more useful for them, because technology in the end, once all the models are like have reached a point where the marginal utility doesn't increase by a lot, everybody's going to have similar kind of technology, just a little different here and there. So the playing field has leveled up in technology, but what is different is how embedded are you in your customer's workflow. How are you replaceable, are you not replaceable, are you adding more value to them every year, so that they are more they tend to like keep you rather than replace you. So it's all about finding how, what are the other things around technology that is creating their differentiation.
Thanks. I'd love to know. There's a lot of founders in the crowd, and I think they want to become a portfolio company for a VC out there, and they're your portfolio companies are coming to you with questions. I'm hoping frequently. What are some of the current pain points that your founders are really requesting your help from or about?
So a lot of the time, the help that they are requesting from us is that they 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 kind of like want to understand like how they should be actually putting their money into work. They are asking like what we should prioritize. They see all the competition out there, and what they're trying to do is they're trying to run in the same race. They're trying to get onto the momentum train because they are seeing momentum getting rewarded like anything currently out there. Companies are scaling crazy. Companies without revenue are getting crazy valuations as well. So they're seeing all that, and amidst and in all that mix, what they're trying to do is they are trying to be out there, and they're trying to like do multiple things together. So what they're asking us is how they should proceed, how should they look at the competition now, how should they actually work in terms of when they look at the competition. And the advice that we usually give them is focus on the wedge that actually makes you stand out, focus on the vertical that actually makes you stand out, and then think about scaling horizontally. Like I always give example of Anthropic. Like they scaled their particular AI frontier model first without like focusing on, okay, what industry we want to target. They focused on building their product very exceptional. And once they had that, they launched into multiple industries. They first launched into legal, then they did the SaaS collapse, and then they came for financial firms, and now they have launched the consulting arm as well. And they're gonna like expand horizontally. That's one advice that we give to our founders, that focus on your vertical, focus on your problem, focus on your customers, and then think about the broad perspective once you've reached a scale where you are exceptional in your field.
And Sonny, what are they asking you? And maybe what should they be asking you? Maybe sometimes they're not asking the right question.
Yeah, sometimes I don't even know what to ask either. It's a bit of a mixed bag. It depends on the company, the stage, the sector. Generally, most of the founders we're investing in have already exited at least once or twice, and so the traditional questions that they may ask a traditional venture fund, we don't really get as much. What we focus on is, okay, the founder has a company and a product that's working. Where can we apply this technology into a sector that they may not have thought, or to an end case or user that they don't have access to? And that's where I think, going back to the initial question about what's changed in the industry, things are blurred. There's not these clear divisions of, here's an AI company, here's a robotics company, here's an energy company. I'm seeing founders build technologies that have so many applications. And so to understand multiple dots that maybe a traditional investor is not trained to think about, and having those conversations with those founders unlocks a level of arbitrage that even they never thought was initially possible. And so they're also interested in understanding how some of these technologies can be applied, and the contracting vehicles have opened up tremendously. So like we think more in terms of pure play tech, and then where's the application of this tech, and less so I think what a traditional venture or investor typically thinks about. When it comes to the questions founders don't ask, I think a lot of the key of why and how we invest is based on trust. So when founders can come to you and say, "Here's what my biggest challenges truly are. Uh, can you actually help?" That's a great sniff test. Some people, and I've seen it across the spectrum, companies that have raised hundreds of millions of billions of dollars, the founders are a little bit more marketing and show people. And so I think the music has stopped in our industry, and you have to be able to underwrite and defend your decisions. And you can only do that if you have a real relationship with the founders. And so, like, when I talk to founders, and I know Yotis, my partner, does as well, we're in there strategic partners. We can say like, hey, we don't have hundreds of portfolio companies. Where can we specifically help you bring in a revenue contract? What kind of things do you need? And sometimes that's not capital. Like sometimes the founders that say, you know what, I don't want to take this money because it comes with these types of consequences. The ones who are aware of that, that's also another great green light. The ones who, again, are transparent about their problems, and then the ones who think long term. I think another problem generally in the industry is this race that Anuj mentioned. Everyone's trying to race, but where's the finish line, and what are you actually racing towards? And I think the people that we're working with generally understand that, I don't need to be successful immediately. I'm willing to wait and be patient and work with the right people to outlive the competition. And we operate under that same framework when we make investments and even as investors. And so the founders that are a little bit more patient and typically aren't just greedy to raise larger rounds, with top VC or brands, I think are going to outlive a lot of the, let's say, marketing and fluff in the market. And those are the types of things that we look for in founders.
To be honest, I would like to add something to
Yeah.
what Sunny said. On top of what he said, founders who focus more on the actual operational matrix of their business rather than the vanity matrix are the ones who actually go really long. Because if you're only focusing on vanity matrix, you're kind of like just focusing on next fundraise rather than actually working on your business and the development of it. So focusing on actual operational like matrix is more important right now.
Yeah, I think, one gauge that I've seen commonly used for an early conversation with a VC is that if you're on that first, let's say you've had the first 5-minute combo, and now you're in a 30-minute combo with like maybe 4 or 5 of their team members, that call should really be a 50-50 back and forth. And correct me if I'm wrong, but the best calls that I've been in with VCs with our founders is it's like more of an ask and a tell between the two groups. So if they're not having that conversation with your prospect VC and you're not asking them the right questions, they're not going to keep asking you the right questions, and it's going to go nowhere. So something to keep in mind for some of the early stage founders out there. The first part of what you're talking about with the tech convergence, perfect segue because I'm going to jump right into that and about how AI, energy tech, robotics, and aerospace convergence is really reshaping the long-term portfolio of funds nowadays. And share maybe what you guys have developed around that.
Yeah, for sure. So let's use AI agents. So AI agents is an enterprise SaaS application. At the end of the day, it can automate human workforce. That same technology has applications with the government. If you look at what Doge was attempting to do and the inefficiencies and again, some of our federal institutions, it's unlocked an opportunity to take that tech and apply it to the government. And so when we look at the convergence, it's okay, some of this technology can generate multiple pathways of revenue and exits. If you look at deep tech over the last 2 decades, this stuff was funded by governments, it was funded by grants, and typically private individuals. And I use satellites and space technology as a great example. There was no commercial market. I mean, this was a bunch of guys that got a bunch of R&D money and hoped and prayed that one day it could generate some revenue. And that's changed. Now when we're looking at even simple things like a humanoid, if you think about what a humanoid is, it's a combination of a bunch of different technologies. It's software, it's the actual hardware, it's batteries, it's sensors, IoT. And so traditionally, all these things were independently developed in silos, and now they've all been combined. And this convergence, I really feel is going to unlock exponential upside into a very small group of investors and companies that not only have the discipline to build product the right way and retain talent, but then the scalability of working with strategic corporate and government partners. And I think they're going to get all the money. So we've seen some of that happen in real time in the market. What we haven't seen is the impacts of that in downstream M&A and then how investors will deploy. So when I think about the convergence, and these are the conversations I have with certain founders, it's okay, where can we take this technology? And then we kind of use that as a vetting mechanism, because if the founder truly understands the technology, they're going to understand the applications. And if they can understand the applications, they can size the market, they can create a go-to-market strategy, and they can create a plan to finance that. And that's where I think the magic really happens. Not all founders are focused and not all investors are aware. So I think, the next 3 to 5 years, the dust is going to settle, and whoever is in the right companies will pretty much have a huge ownership and stake over the market.
Yeah, you should just see, oh, we're a drone company, but now we're a quantum-enabled drone SaaS with space satellites now. Everything has to be included or it's nothing. Anuj, I'd love to hear maybe from the operator side, some of the complexities of dealing with deeper tech and how you're seeing them. What are some of the hurdles they have to get over?
So some of the hurdles that we have seen within our portfolio companies is that specifically early stage is actually proving product market fit. Sunny has mentioned that as well, that like sometimes founders think that their product is more suitable for a particular industry, but as they move ahead in their product market fit stage, they try to like contact enterprises for partnerships to prove it on the floor itself. That's when they actually realize that probably it's not the best fit. And that's where like you have to be like really open. We have a portfolio company very early stage, two very young founders, probably like 20, 21 years old in SF. And what they're trying to build is they're trying to build the AI OS layer for all the machines which are out there, robots out there, which are in the manufacturing industry. And they believe they can actually make these robots do multiple things than what they are actually programmed to. So they found out that the problem is that you have to manually do code and everything to make a robot do certain things. But with AI and Vision AI, you can actually make the robots teach faster. They thought that was the only use case for the technology, but and specifically sectors that they were trying to work in. But eventually, as they started moving ahead, They got a good partnership with one of the bigger manufacturers of the space, but later they realized that instead of just that, they can actually go into a simple, simple steps such as like pick and pack. So like packaging of pharmaceutical products. So that's like from just the manufacturing of like certain machinery equipments, they went into the packaging of pharmaceuticals. So it's just about being open to where you might go in future, understanding that your product can have multiple users as well. You may need to pivot as well because deep tech is like that. Like currently you think, okay, it's just the only purpose right now, but in future something new may pop up and you just have to be like very, very open about it.
Great. And so if I'm a twice exited founder and I'm in a space that I deeply understand, how do you guys on the other side of the table prove that you have a team capable of understanding what they're doing and helping them push that further? Because I mean, if, that's probably one of the first questions I'm asking. Like, what are you helping me with? What do you bring to the table?
Yeah, the founder profile has changed. In deep tech, I mean, you're looking at researchers, PhD scientists that know a heck a lot more than investors do. Whether investors admit it or not is a different story. But they're really smart. Where they lack is typically business knowledge, past experience on scaling operational stuff, hiring. So I think the first thing is to understand, okay, what is the true value of the company? Is it really technical? Is it more first to market? Is it scalability? Is it there's a gap in the market and there's just not a lot of competition, and this is something that we could see become a category leader? Is it that their market is growing so fast that the two, three, four players will all win, or is it a market where one company is going to take the entire share? So once you start to understand kind of the world and the mapping of things, then you can start to categorize what this company specifically falls under. And then once you understand that, just again being aware, you can start to reverse engineer where that company can go. So that's where I think we look at companies a little bit differently, but I would say generally the scientists and researchers who understand enough of that and can articulate it and then understand their gaps are the ones that I often see win. I've seen in the space industry where sometimes that's not the case. Sometimes it takes like someone like Elon Musk to come in and say, you know what, I'm going to create SpaceX and I'm going to hire all the kind of researchers and then bring them onto my ship, and then that ship is the one that scales. And so I think it's having the accurate picture of macro and micro and geopolitics and where that specific founder's technical ability sits. And then as an investor, it's can you actually fill in the gaps and is it worth your time? Because that's another element to this where it's also capital efficiency for the investor. It's not just capital efficiency for the startups. And as an investor, if you think like that, you're going to end up outperforming, I think, the entire market. So it's having both that dual lens and then understanding where to deploy.
Now, I know as investors, you guys have lots of metrics that you guys track, and one of those things is timelines. How have you seen timelines shift with the change in these converging technologies or even emerging technologies? What was a metric that you tracked before, and where is it at now?
So because the companies are like scaling like really fast now, so top line metrics have also become a little artificial in some of the industries. So earlier, while the focus was on, okay, when did you hit 5, 10, 15, 50 million ARR revenue? Now it's more about, okay, you are hitting that, but what are your bottom line metrics as well? Where are you in hitting those? Are you on a path to a sustainable profitability in future? Or are you just not caring about that and just thinking about growth at all cost? And then you think that in future, I'll just go and think about profitability and operational efficiency. So like that is one thing that has changed very dramatically for us, but it also depends on industry to industry. Some industries demand that top line matrix are the key important things, but some don't. But one key matrix that we are actually seeing now, because the building cycle has like literally collapsed the timelines, what we are seeing is how good is your retention, your user retention. That is the clearest indication whether people actually like your product or not. If you have good user retention and they are like kind of like increasing their spend year over year, then that is a good sign that you have embedded yourself into their workflow clearly. And instead of traction, if you show that, if you show the quality of like users, that's really good. And one thing that we have actually started focusing on is that sometimes what companies do is they bring on one client or two clients, and they're done. They're like, okay, we have two big clients and we just go from there. There is concentration of that. But when you look at as a VC lens, you see that as a problem. You realize that like your product is probably embedded or useful for only one or two clients. It's like, how is that going to scale? And that also relates to the exit in future as well. Like how are the other acquirers or maybe public markets are going to look at that? Like if that one customer fails or takes out their contract, where is your company? So it's all about now going into alternate data sets, trying to find out other than the typical matrix that we used to look at, and trying to figure out, okay, where does the company lie?
Yeah, the way we see that at first is deal sourcing. So most of our deals are sourced organically through founders or investors, and so what that means is we aren't pressured to due diligence rapidly, right? Like a lot of funds, what they'll do is they have a certain amount of time that they have to do due diligence. They have to uncover as much as possible, and a lot of times the founders won't really share everything unless if you're a lead or you're writing a check that's big enough and worth their time. So there's this natural competitive dynamic. And what comes out of that is the lack of due diligence and understanding things like top line revenue, where it could you could paint the picture of it's 2xing, 2xing, 3xing, but then you look under the hood and you see it's all new accounts, right? There's not a recurring clients, or it's one big client that can shift at any moment and their contract ends. And so it's those types of things that, because we're sourcing through our trusted network of founders, we by the time we get a deal, we typically have anywhere from 2 to, let's say, 5 years of understanding of the founder, their past performance. Here's what they pitched. Here's what they did. And so by the time we get a deal, our diligence, I think, is just best in class and better than market. The other thing is how fast and why are they growing as fast as they are? So I often find a lot of times there's capital raises that are happening just because there's a cash grab from an investor to founder perspective. But what's changed is secondary market. So taking a step back, if you look at what's happening in NASDAQ, NYSE, and IPO markets, they've dried up. And so the big banks have been buying out secondary market providers. And so typically, the individuals who don't have access to these types of deals are now getting access. And so what that's unlocked, along with tokenization, which I'm happy to get into, but that's going to unlock a means of actually getting liquidity and then getting value out of a typically private transaction, meaning you don't need to raise aggressively constantly, right? You can just build your businesses, rely on secondary markets and tokenization, and then that can actually fund the business and scale. And so I think we view it a little bit differently than that compressed timeline. But in general, yeah, like we're seeing companies that go from 400 million in valuation to 2 billion within the matter of 3 months, 4 months. And although revenues have gone up, you take a deeper look into the revenues, and that they're a little fishy. So yeah, I think it's just separating the signal from the noise, and that's where you can win.
Yeah, we could have an entire another podcast on tokenization, but so we won't go there. And I want to, before we wrap up, I do want to touch on exits. And since we have some, earlier stage founders here, what are really quickly, what's something that every early stage founder should really do to prepare themselves for an exit in the most, efficient manner or stress-free manner? Like, what would be one thing that you would give them as advice for preparing for a future exit?
So one thing would be to actually not think about exit much and think about actually building the business themselves. It's all about like incremental growth. So it's like you can have a broader vision, you can have a longer vision of being a public company, but you have to think that can every year we can incrementally add up to our strategy, our company, and make it bigger. maybe valuation is one of the matrix, but valuations are like completely different now. But as a company yourself, do you believe that you are adding more value to your customers every year? And that's one thing that they should focus on, because that's what's gonna matter in the end about when the exit happens.
Yeah, I think it's the opposite actually. I think the problem is you ask a founder, "What's your exit strategy?" and they'll say, "Oh, I want to sell to Google." Well, that's not actually thinking about exits. When you ask the question, what I would advise is you should think about exits. Like, what does it take to actually exit a business? What should your operations look like? What kind of revenues do you need? I was an investment banker, so I'm a little biased, but knowing what the end goal looks like, I think will help the right founder shape the company the right way. And then again, most people don't realize like majority of founders actually get replaced before exits, and so it's like if the founder that you're investing in is probably going to get cut or fired or let go prior to exit, that's a problem. And when you start asking questions around exit strategy and how much of this do you understand, do you understand the current landscape of buyers, then you can understand if that founder actually knows where the liquidity pathways are, and if they do, it's a great benefit. This isn't the case for all founders. If there's a founder who is clearly the leader in the market and they're getting a ton of money, it's probably going to solve itself. But if that founder in the company isn't that, I would argue that they have to know how to exit, or at least understand enough about it in order to position the business for it.
Yeah, the way I prep my founders for that conversation is, especially when they're having issues with the board, around a leadership role. Is your equity in your title or is it in the company? Like, think about it. What are you really fighting for here? It's the company. Don't just because you want to be CEO, right? You want to have that title, it doesn't mean it's always the right fit. So I want to go ahead and open up the floor to some questions. Looks like we got some hands raised, ready to go.
I'm trying to understand like how our investors are evaluating and on the long-term value and the defensibility in their investments.
That's a huge question.
Well, I would say all of the above and many more different things as well. But it, to be honest, it depends on the stage of the company. If it's an early stage companies, we typically have like a 10 question, uh, like a first pass analysis that we do for those companies, and we want those 10 questions answered. I'll give you 5 of those because those are the most basic ones. That's like, first is what problem are you solving? Second is who are you and why you are the best person to solve that thing. Third is why. Why are you doing that? And why there is a need as of now for that product. Fourth is how you are doing that. What's your technology stack behind that? And lastly will be what's your team and how are you going to build that out in future. So these are the 5 most necessary thing that we look at for every company and try to, and that can kind of like gives us an idea onto how it is. For early stage companies, I would say it's a so for any company, it's a mix of qualitative and quantitative factors. The earlier the company, the more qualitative it becomes because there is less to underwrite. There is technology, some part of it, product market fit may be there, maybe not there, but you're largely underwriting the company based on the founder themselves, what the founder has done so far, what has been their prior experience, what makes them the best fit for that problem solving. And the later the company, the more quantitative you become because you have numbers, you have financial statements to actually see their growth. You have more public information on the market itself. Sometimes the early stage companies are actually trying to completely disrupt a new market. So now there is actually not even a market there, but you're trying to like create something completely different. How are you going to touch that? So it's based on your conviction into the founder and how much conviction the founder has in themselves that they will be able to solve that problem. So it's a lot of factors, but yeah, in early stage, founder is the one that we look at most.
Congratulations once again. I just want to touch back again on the founder's point of view we're discussing, because I know that it's not easy to start the discussion about what is the exit moment or not. But knowing that we have so many successful family business entrepreneurs for 10 years, 15, 20 years, how exactly, okay, in your point of view, what's the moment you will start to emphasize in these discussions about the exit moment for a founder? Only in good moments or in weak moments that they are not performing for 1, 2, 3 years? Is there a methodology on this approach?
Yeah, I mean, again, it's investor profile. So venture capitalists typically have to see X's on their investment. That's skewed more towards tech. There's tons of great businesses that I think private equity and smaller non-traditional venture funds can definitely take a look at. And those conversations, I mean, again, it goes back to your goals. Like you mentioned family business. Some family businesses I know are doing it for 50 years. Others want to do it for 10 and exit. Other times, which I often find is the gray zone, which I'm sure you guys have some thoughts on, is there's a lack of liquidity generally. So, like I did investment banking on Wall Street for large deals. As you go downstream, to have usually it's your personal banker that can help connect some of those dots. It could be your accountant, your lawyer. They'll typically start to gear the business towards a sale, and then you can work with specific people to understand first what's actually the market for this business. It's like is there a potential buyers or strategic? Typically, it could be private equity. That's usually like 60% of those family businesses will be private equity roll-ups strategies. But it's having a pulse on the market. So the wrong thing to do is to think about it when the business is going down, right? Or that's why you want to sell. The right thing to do is just be proactive. Just understand like this is an opportunity for me to get some value out from the business that my family built. And set benchmarks. So like for some of the ultra high net worth people we work with, I typically say, hey, like every 2 to 3 years, do a valuation on your business, and that will typically set the stage on where there could be demand and exit opportunities, and you can make decisions of if you want to pay the fees and go through a process or not.
My question is regarding seed stage valuations. So a company that has maybe product market fit and some sales, but doesn't have millions of dollars in ARR, how do you value, like, what other types of assets are there? We're talking about moats and intangible things. Like, how do you value that? Is discounted cash flow or on, potential market share or something like that? I mean, it's probably an art more than a science, or what's your opinion on that?
What kind of business?
A hardware business. ChatGPT said we're valued at 5 to 12 million, and then other people will say, 3 or something like that. And we took over from another company. We have IP and all, but we're getting valuations all over the place. And I know it's probably more of an art, but I wanted to know, like, specifically what type of assets that you look for, so I know what to build.
To be honest, like when you talk about like evaluation and evaluating early stage companies, it's as difficult as it is for you, it is for us as well. Because obviously we don't like even when you make discounted cash flow models, you take historical financial statements and then you predict those based on certain factors for future. But when you don't have anything, how do you predict future? Like I like we also don't have a magic ball that we can see. It's all about like again the I think you mentioned it yourself. It's more art than science at early stage. It's more about whether we believe that the problem that you are trying to solve is bigger and whether that's going to expand in future as well. So that's how we try to evaluate whether that company, okay, market share you definitely can gain, but is the market big enough? Is the problem big enough for you to actually go in there and create a big organizations out of it? And then how you build it, that can change over time as well. You can focus on your tech stack earlier, you can focus on your architecture around it earlier, you can focus on building your research and development like team around it. But like so that can change, but can the problem is the problem big enough for us to even like start putting money into it? That's one basic question that we try to answer. But how you build it is it's very like it depends on company to company and how you focus on. If you're a more technology based founder, you have a tech background, you would probably focus on that. But if you're a business founder with business mindset, business background, you would try to bring on somebody to work on the tech while while you work on the distribution side of it. So it's just about balancing those things.
I mean, one thing we always tell our founders, especially around their first raise, is that your first valuation doesn't matter and probably never will. It's just a number.
And what I like to do with them to kind of calm them at that time is walk them backwards from dilution, to say, what amount of money do you need to raise, and how much of your company are you willing to give up down the road for that amount of money? And you'll all of a sudden, the picture becomes really clear. Like, I need $500,000 to get to XY stage, right? And at a series A, that's going to then dilute me to X%. It's simple math. And then you go, okay, I'm comfortable with that, or I'm not comfortable with that. And then it's your job to then sell that to a VC on the full vision, the full picture. But it's really about, like, it's going to mean nothing. Like, it's going to be a random number that's just going to be forgotten at your next raise. So
Thank you both for your time. Really, really good insights. Quick question. I'm not sure if you saw the article. It came out by Sequoia in March, which was "Service is the New Software." And so, looking to see one how you would define that, because obviously with the Anthropic and OpenAI news this week with the deployment company, that's the space where I play, kind of the consulting space, and a lot of my work is services with a tech stack involved. Still trying to round out what that really means and trying to get really clear on the definition of service as a software instead of software as a service. Would love to understand how you would define that and where you think the deployment company is going, how they intend to really implement, and kind of tie actual business need to AI implementation.
Yeah, did you see the news for OpenAI also starting consulting company and getting backing from all the major banks and PE companies out there? So it's like they're trying to enter every market that they can, and there is gonna be a lot of consolidation that's gonna happen as well, and we see that amongst our portfolio companies as well. But in terms of like that industry specifically, uh, again, what we saw even in the public markets, because we were tracking the whole SaaS apocalypse that happened with Claude launching that product, and then suddenly all software stocks going down. What we have seen is a gradual recovery into that. It's like it has become a tactics from the big companies that they scare you off so that the investors spook, and then there is certainly more traction for these companies. And then but as investors kind of like bring that in, that okay, all these software companies which are out there, they have deeply embedded their products into their clients. They're not going anywhere, they are also evolving, they're not sitting there. So it's all about how you are evolving with them, how you are able to use them in your businesses as well. And how do you you can't really predict what's their next move, how they are going to do that. But like I'll say that software as a service model, that's it's not dead. It's not going to die any sooner. I was on a podcast recently with somebody who was, I think, in Snowflake before, and then moved to another service provider. And I asked them the same question because it was around that time, and they said particularly that like no, like that's not going to happen because the tech is just like too big. It's too big for anybody to just come in and start deploying things for like just for AI and agents and themselves as well. But it's like because they're so deeply embedded with their clients that nobody is gonna like change them unless they see extreme differential value. And same for like early stage founders in that sense as well. If you think you know your customer better than anybody else, then that's your niche and that's your differentiation. So it's all about how well do you know your clients.
My question to you is, during the due diligence process, on average, how many meetings do you have before you write that check? And does it vary based on if it's early stage or later stage? Because I know you guys invest at different stages as well.
A lot of times what has happened is that we have had first meetings and then we would have like rejected a startup at that time,
Mhm.
but then they later come back in 3 months with improved performances or something different, and then we would like okay, we would take them more seriously, have a conversation. It's difficult to actually quantify like how many meetings we would on average will have. Sometimes it's like first meeting where you just get to know the product, then you go back to a drawing board, you do your research, you research competitors, you research the whole space, and then you go back to them and ask them more questions around it. And it's possible that I may not need another meeting after that, but it's also possible I may need a meeting after that. So it just depends. And sometimes if it's a very late stage companies, there's nobody to actually answer our questions. They would just provide you the information that there are, and they'll be like, okay, make your decision. Yeah, and one thing we're seeing with the unicorns from Silicon Valley is that they're not even giving you any information. They're like, everything that we have is out there on the media. Just go do your research and let us know when you are ready to mail in the money.
Google me.
Yeah, exactly. That's one founder
That's
who
my
said
pitch
that.
deck. Just
Google
says
us.
Google me.
Exactly. So it's like, because they are being so private about their information as well, that they don't want that to get out. So it's like, how do you underwrite those companies? So it just depends. Like if it's early stage, founders are more open to have more conversation, share more information as well, and have a deep one-on-one conversation with us.
My question is more of a market question overall. Recent report shows that several companies that have integrated a lot of the agentic have not seen that much of a savings opportunity with it. So my question to you two is: do you see more of a hedge happening with the approach towards agentic, maybe a reframe, or maybe a revision towards its use case and application?
Yeah, it depends on the companies. So generally, if you look at Fortune 500 to start, the CTO, the CEO, and the board were never aligned generally. I mean, CTO roles were like tech guys that built stuff, and a lot of them just turned into IT. And there was a focus on revenue and budgets, and that's rapidly changed because of AI is now being rewarded. Companies, when they fire folks or let them go, I should say, are actually getting points in the stock market for efficiency. And so it's now become an incentive for CEOs to integrate tech. They have to work with the CTOs because it's impacting EPS or earnings per share and their bottom line. And so when you read about some of these trends pushed out by venture capitalists, and then when you look at what Fortune 500 companies are doing in the boardrooms, and you understand that they feel they have to integrate some of this to actually compete, there's a lot of gray zone and fluff. But what we're seeing coming out of that are successful pilots and certain companies that are actually integrating their tech, and it's resulting in case studies where the tech is working. And going back to where to deploy as well, that's where, as an investor, you should be looking. It's like, where's the moat? Is there a specific service, solution, application that is generating sticky revenue? And it's not just AI or agentic AI broadly. And then how scalable is that user base or enterprise customer base? And so I think that the trends are changing because the board and leadership are finally getting benefit from integrating technology, and technology is fundamentally changing the way humans are engaging. I mean, it's the way I think about it is anything you do in front of a computer is being automated, whether you know it or not. And so that puts most people in a pretty, I think, awkward and a little bit uncertain time. And so it's a matter of understanding where is your moat as a human. And if your moat is whether it's in-person meetings or building communities or understanding your customers' needs better than artificial intelligence, that is something that is scalable and sustainable. But everything else, like general functions over a computer, I mean, I would expect them to be replaced in the next 3 to 5 years. And we're backing some of the companies that are have successful case studies doing that.
Hey guys, thank you guys so much for the event. I went to WPI up in Worcester, just graduated. My question or the guidance that I'm looking for right now is understanding where to move forward within my own career. I was a systems engineer first when I just graduated last year, and I stayed there until January. They ceased operations. It was very unfortunate. From that time, I've been building apps and other different types of software. 'Cause, with the new resources that we have available to us, like you were just saying, anybody can vibe code something if they can think and speak. Um, they can tell AI what they want. But where I'm getting and lacking the understanding is, why am I not looked at as more valuable than I am? And how do I translate that more to the outside? So, I mean, I'm getting stuck over here. I'm downtown Fort Lauderdale. I'm sitting there every day thinking like, where am I going to apply any value? Because I'm building out things, I'm making products. I have an app right now. I have 500 plus users on. Nobody's paying for it. And I'm uneducated to where people go and start reaching out to VCs and funding. I don't have the answer for myself. And just coming from that perspective that I'm giving you, is there anything that you can help me or give me a better perspective on the trajectory I should be putting myself towards?
What's the saying that people say? Build shit people want. Yeah. I mean, if you have people that are logging in and using your app regularly, if they wouldn't pay for it ever, maybe that's not the app to build. Maybe pivot and keep trying. I mean, it sounds like you competent kid. You plenty of time to keep working on it.
Send us your resume. We're hiring.
There it is. Show up here. Show up at the Fort Lauderdale Tech Meetup. Let's go.
That was another episode of Founder Tactics. Thank you so much for listening. If you'd like to get updates on new episodes, live recordings, and everything happening in our founder community, make sure to subscribe, follow, and rate the podcast. And also, you can head to foundertactics.com to learn more about our work. See you next time.